Ladies and gentlemen, I'm delighted to introduce you to our next panel, the Crypto Saga, Latest Developments, KYC, and Anti-Fraud Resistance. This discussion will look into the growth and trends of digital assets in APAC, as well as latest developments in the KYC, anti-money laundering processes, and compliance with international regulations. Please give a warm welcome to our moderator, Malik Khan Kotadia, the co-founder and chairman of Finnovation Labs.
Thank you very much. And hi, ladies and gentlemen. Good morning. It's a pleasure to be back here in Bangkok after almost 3 years, or slightly more than 3 years. I was last here for the Bangkok FinTech Fair, and I was just chatting with them that we've seen a world pre-COVID and post-COVID for many of us who've been regulars on the conference circuit. So it's good to be back on stage. Today, we are also going to be talking about a topic which I think many of you are either personally invested in, monetarily, or at least intellectually, and in terms of your organizations, etc. It's, whenever it goes crazy up or crazy down, it's always in the news. And my attempt usually as a moderator of these kinds of panels is to cut through the noise and the hype and the FUD and use the collective brainpower of our experts here to really try and distill what's happening, what's likely to happen. Nobody has a crystal ball, but of course, how the market is evolving and how, if I may say so, this crypto winter is different qualitatively from the last crypto winter of 2017-18, which many of us have seen. We've seen a lot more institutional participation in the interim. We've seen a lot more maturing of the industry. And yet, at the same time, we continue to see many, many gaps, especially with respect to controls, compliance, KYC, all the things which I must sadly say that were not very popular themes at crypto events that I have spoken at during the bull run. Now, of course, everybody is wanting to go back to the drawing board and say that, hey, if you're going to talk about DeFi, first understand the Fi, and then talk about the D, because you cannot have DeFi without the Fi and the understanding of Fi, which includes all the Cs, credit, controls, compliance, etc. So without any further ado, let me start by introducing a wonderful panel that we have here. They will bring in their own different perspectives as well. So I'll just request each of the panelists to do a very quick 1-minute introduction of themselves, starting with Khairi, then Pamela, Taka, and Phil finally.
All right, thank you. Good morning. My name is Khairi. I am the general manager of Okcoin Singapore, and I also lead the sales for APAC. Been in the FX industry for more than 10 years, made a switch to crypto, enjoying the winter right now, but good to be here.
Hi everyone, thanks for having me here today. So I'm Pamela, I'm currently leading sales for APAC at TALOS, which is a leading digital asset trading infrastructure. So started my career doing equity sales at Credit Suisse, and then my last role is with Almex, which is they run multiple institution execution venues for FX and crypto. Spent my last 6 months in TALOS, which is really meaningful and exciting, where we help institutions, both buy side and the sell side, by giving them an umbrella of tools that they are familiar in equity and FX and help them interact with crypto. Yeah, moving to Taka.
Thank you for your audience. My name is Takatoshi, or you could call me Taka for short. I'm the head of sales for APAC for Copper. Copper is a institutional grade digital asset custodian. Not only do we provide secure custody for our institutional investors and other crypto projects, but also provide them the access to exchanges, OTC brokers, staking, DeFi, many service lines that are necessary in the trading world today. I spent about 20 years in the hedge fund space as a PM analyst as well, and got into the crypto industry around 2018. So thank you for having me again.
Hi, everybody. My name is Phil. I'm the global CEO of B2C2, a company that specializes in institutional side OTC liquidity provision. Mainly, we service clients who are retail brokers, large hedge funds, and others, so pure B2B liquidity provision in the crypto space. And before B2C2, I used to oversee the electronic FX trading at Goldman Sachs in London. Thank you.
Thank you, everyone. And very quickly about me. So I had my V 1.0 avatar as a banker for about 20 years. I worked in Citi for about 14. mostly in digital banking and digital payments, etc., all over the world, Singapore, India, Philippines, London, New York, etc. And then I made the switch to the other side, the 2.0, where I wear multiple hats. You can add me up on LinkedIn. And I do speak regularly at conferences. I'm also a professor of fintech, so I decided to try and help develop the future leaders of fintech and crypto with some grounded perspectives. With that, let's start with, I guess, the elephant in the room, the question many of us have been asking or are still asking. And I'll ask this to Pam and Khairi. As I said, in my own personal perspectives and experience, this crypto winter is qualitatively different from the one we saw in 2017-18. But I want to hear your perspectives and what do you see as the triggers for this, call it crash, downturn, unwinding, winter, whatever fancies your imagination. What do you see as the triggers? And more importantly, for serious industry participants like us, what are the key learnings? We can start with you.
Yeah, so I think we all have to agree that it's a very challenging environment, right? Globally, I think not just for crypto. We have a war, we have a pandemic behind us. It's getting better, but it's a tough market. So the difference I think we need to really learn, it's really for institutions coming into crypto. And the difference between institutions and retail is that institutions, they know that markets can go up and down. They have a longer term horizon strategically. So at TALOS, we have a very interesting vantage point because we see what institutions from both buy side and sell side do globally with billions of notionals of trades flowing through our pipes every week. And what we see right now is, in fact, we see a ton of new players coming in for institutions. A lot of them actually, they said last year that they agreed to participate in crypto and they dedicate resources for that, and that is not going to change. In fact, I think overall market prices went down this year, but we do see more demand from institutional in terms of digital assets from both buy side and sell side flow. So I think what the key learning point as industry participants for us really is that the best time to build is actually in the bear market, where you really have time to really focus on your infrastructure. What's the best way to set up your trading desk if you are from buy side? From the sell side, what is the way you could look at it to improve client user experience and things like this? Yeah.
So the first part of the question was what triggered the crypto winter. I think we all have. There's something that everyone can Google, but in summary, there was a list of bad risk management that happened, and Warren Buffett did quoted once saying that only when the tide goes down, then you will see who are the ones swimming naked. And the ones that have been swimming naked, we all know now, would be either in legal turmoils now or have since closed down. But so the second part of the question then is what are the takeaways from this? I think the biggest two takeaways I have from this is having very good risk management, understanding your risk entirely on the things that you are investing in. I mean, we have so much innovation that's going on right now, much more than what we had 10 years ago in FX. And every other day we have more innovation coming up, changing how crypto is being traded, being designed. But we need to always take a couple of steps back and say, how risky are these assets? How risky is this business model? And if we then have that ability to take a breather and not just to plunge into things and having the fear of missing out, I think that would be a way to mitigate some risk in the market. And the second takeaway for me is we all do know that some of the reasons why some of the companies went down is because they put all their eggs in one basket. And I think, I mean, it sounds passé, but yeah, just don't put all your eggs in one basket.
Thank you. Go ahead, Phil.
I find this question to be fascinating because what happened, if you look at 2021, we all know valuations are completely out of control, right? Not just in crypto, but a lot of companies. And really, when you were trying to print these valuation at 5 billion, 10 billion, whatever, you were trying to justify it by revenue. And what happened was the bad players just literally started taking a lot of risk. And a lot of these exchanges also offer non-liquidating accounts. So the truth is, there's a lot of interesting setup that was, the culprit was 2021, this kind of a growth at any means. And then 2022 came, the market came down, and then you had the systemic risk. So a few takeaways that I had was, at B2C2, we're very careful at DD, but we never imagined, and we got away with not getting hit by a lot of these counterparties because we just said, okay, something doesn't make sense here. How is it that their business model is ABC, but they're able to generate whatever valuation, whatever revenue? And what's interesting to me is that a lot of the VC firms valued these companies at billions of dollars. So they did thorough DD, and all of these companies got away with it. What we realized is that we really need to dig in even further to the risk management policy and everything else. And also from our perspective, we needed to do more asset liability management, right? ALM. It's very important in this crypto world to also make sure that your exposure is managed in an effective way. And this is something that I think when you have credit contagion like you did in June, it becomes a reality. And the serious players are now considering this to be, okay, we did the simple DD, we see your balance sheet, tell us more. What is your risk management committee like? How's the governance? Tell us more, and then on our side, we have a risk weighting and asset liability management. This is not an easy market. I mean, I've done equity, done an FX, never seen a market like this where you have to actually think further, and that's the reality that I think we have to face. That, things like this happen, and the level of professionalism go up, but the way we have to react is both transparency and also understanding how to manage the assets and liabilities so that you don't have a situation where one company goes and everybody goes.
Thank you. So I think some key takeaways from this, especially what Pam said, crypto winters are or any kind of a winter is a good time to put your heads down, get beyond all the froth and the noise and the media hype, and for serious players, really focus on fixing the gaps and building something meaningful, sustainable, scalable, and hopefully profitable in a realistic time span, which can last for the next 10, 20, 30 years. If we say that DeFi is going to change the world of finance by 2030 or 35 or 40, whatever you believe in, then this is perhaps a good time. And history has many precedents. As a professor, I always tell my students, when you have this kind of a confusing scenario, history offers us some clues, especially for people like us who are beyond 40, who've seen various bubbles, right from the dot-com bubble. We saw Web 1.0 and the crash which came with that, and we saw how the next generation of companies that survived, like Amazon, etc., are today some of the best companies in the world. And we saw the 2.0 emergence of the platform economy after 2005-06, and we saw the entire social media and the platform economy come to play. So perhaps sometimes the best of companies are incubated and they grow during these leaner periods. The other thing Phil said was very interesting, and I want to press on a little more about this. So Taka, I'm going to come to you. We've heard some triggers, and I think a common theme was recklessness, utter lack of risk management or even acknowledgement of that. And if we see the sequence, we already had the early warning signs back in March. I was on a television interview, and the anchor asked me, it was early days, Bitcoin had fallen from 68,000 to about 45, 50, and she asked me, and sadly my prognosis came true. I said, look, for long-term hodlers, etc., it's a different story, but there are gaps in this market that need to be fixed or at least acknowledged and addressed. And then we saw stable coins, I won't name names, but stable coins which weren't exactly very stable, and we saw how everything collapsed in a matter of 72 hours. We saw some very high-flying names talking about lending and staking, etc., not having either their business models in place, or in the case of some developed markets, you had regulators coming to them and saying, hey, you have a securities license, what the hell are you trying to lend? You don't have a lending license business, and people didn't even understand or acknowledge it. As I said, you can't do DeFi without understanding the FI part of it. And then we saw another high-flying fund, the Three Arrows Capital Saga. So we've seen, you can call it a contagion, or you can say that perhaps there was a period where Flash scored over substance, and now we have people coming back to the drawing board and talking about it. My question to you, Taka, and perhaps to any of you, Pam and others who also want to chime in, is we've seen what are the key takeaways. If you had to give some very tangible, practical advice to our audience here and to also others in the market on what can you do to fortify your control, compliance, KYC, risk management, credit, all the boring stuff of FI, but all the stuff without which this industry cannot mature to the next level. What would those one or two tangible suggestions be? Taka, we'll start with you, and then you can, others can join in.
Yeah, even at a company like ours as a digital asset custodian, we have hired senior management people who manage risk. And one of the key takeaways, and I think most of all of the panelists just mentioned about, is risk management. So I think that crypto as an asset class is a lot more volatile than any other asset classes, and that requires a lot more risk management than the other asset classes. So what this industry needs a lot more, and especially during this, I would say, the last 2 years of market exuberance, is that everybody was chasing, as Phillips mentioned, about meeting their valuations. So everything was kind of put on hold for all the kind of back office risk management, compliance, and et cetera, so they can actually meet those valuations, so they can grow their revenue as quickly as possible, and then kind of patch together, other risk controls later. So I think during this time, what needs to happen is kind of go back and fix those patches into a real management system so they can measure risk. You can calculate what are the upsides and downsides, et cetera, for running that operations first, and then kind of re-examine what the revenue model should be for your business that can actually grow to that valuation that you promised your investors. So I think that's something that during this, I don't know how long it's going to be. Maybe it's, people say 18 months, 24 months, whatever it is that this is the time to kind of think about how to, reorganize the risk management system that should be put into place.
Thank you. And one thing that I personally have seen from the 2017, winter to this one, is we have players like you or Copper, talking about custodial services, all the, as I said, the slightly boring stuff, but very, very important, and if I may say, foundational stuff, right? Before that, we used to see all sorts of hacks on phishing, etc., but people didn't even know how to keep their tokens securely, and people used to lease, either give out their private keys or not have a clue. Now that institutions have come in, we've seen very serious players, including some of my former city colleagues, going into the custodial space, etc. So we're seeing elements of the right kind of foundations being put into place progressively. Pam, I want to come to you. This second crypto winter, we are kind of trying to make sense of it vis-a-vis the first one, and how the market has matured in all fairness, despite some things being more of the same. History repeats. If it doesn't repeat, it certainly rhymes. But we've seen some very tangible structural changes. But tell us, how do you foresee this kind of a winter, whether it is 18 or 24 months or whatever, affecting the overall development of crypto in our region, in APAC, especially when so many institutions have finally opened up, their risk managers have signed up, and this was not the case even, I think, as far back as 2018 or 19, where when I would talk to my banking colleagues, people were not even wanting to touch it with a barge pole. Things changed, and then unfortunately this has come about. And secondly, since we are in an FX conference, how do you foresee the structure of the market, the trading architecture, et cetera, the technology vis-a-vis a much more mature, developed, and perhaps a much more, or a much less, if I may say, rigged market like FX vis-a-vis crypto today?
So So maybe just answering your first question, right? How development would change in the first crypto winter. I think two things, right? One is definitely we have already seen starting in the market right now, which is tougher regulation and uncertainty, right? If you just look at regulation, we've spoke to a lot of banks. We have seen a lot of bulge bracket banks actually taking longer time to come up to market with their crypto product offerings. There's a lot of struggles and takes a lot of time when it comes to internal companies' knowledge upskilling, when it comes to digital assets, compliance challenges, as well as license uncertainty, right? I think even different jurisdictions, whether it's in Europe, in Thailand itself, in Asia, I think regulators are all still trying to understand the framework, getting into consultations with digital asset companies to see what's the best way to do it. So there's really not a proper playbook right now, I would say. So I think that we would see it evolve as we grow and develop in this crypto space. I think the second part of it, which is also what Taka mentioned about, is really risk management, right? If you are a buy-side fund or if you are a sell-side guy, right, looking to go into crypto, right, the first thing that comes into your mind would be having a very nice front end. How do I connect to my LPs? How do I do my trade execution? But I think taking a step back right now with what's happening in crypto winter, I think it's not just about the front end right now, right? A lot of it comes with the back end. And what I mean by back end, right, it's really how robust your reporting tools are, how proper your portfolio management system, credit and risk management systems are. I think these things are starting to surface a lot when we talk to institutions. And I think at TALOS itself, I think we are best represented by our panelists here because I think we work with some of the best in class liquidity providers like B2C2, Okcoin, as well as custody providers like Copper. And we also want to do this in the risk management world where we build some of the more sophisticated risk management systems by partnering with risk experts or even existing risk systems where they also need to figure out how to do some of the proper risk modeling for some of these new digital asset classes. So I think these are things that we are seeing it happening where you do see opportunities for a lot of such back-end reporting tools coming into space. Yeah, so to your second questions about the difference in market structure, I would say in crypto, we need to understand that it's still very fragmented. We are still quite a nascent, although things grow very fast in crypto. If you think about it in FX, a lot of times connections comes very standardized in fixed, right? In crypto, you work with exchanges that are on cloud, and some of them can be in REST, some of them can be in web, some of them can be in fixed. Even if it's fixed, it might be an adapter from REST and web, so it might not be a true fixed connection. And then if you think about OTC dealers, they might have RFS and RFQ. So how do you normalize all these connections and to provide stability and resiliency so that in terms of crypto winter or when crypto crashes during markets volatility, I think these are things that people have to consider when you are interacting with FX and crypto because it's still pretty much different. Yeah.
Thank you. You both wanted to add something. Please go ahead.
Go ahead.
Okay, so I think to make this discussion even more useful for everybody, I think we need to dig into the risk management. So there's different risk management. There's Delta One linear risk management, which is plugging into the liquidity providers and so on. I used to be at Lehman Brothers, and this latest June credit contagion was fascinating to me. It's a credit issue. It's not a linear spot risk issue. So I think when we say risk management, we need to be very, very careful. Credit risk is extremely hard to do. So we already had a CRO, from a very famous CRO that came on board, and we sat around the table and said, how can we mitigate the credit risk? Very hard problem to do. One of the things that I said was asset liability management. But what I think is going to happen in the very near future, because let's be honest, it's not really about taking Bitcoin risk or Ether risk and just leaving it. It's the counterparty. Are they okay? And at the height of June, I think for anybody involved in crypto, people were scared. They were saying, okay, are these guys solvent? Do they have exposure to, we mentioned Three Arrows, but there are other names on the headline. So in the near future, one of the things that has to happen is there needs to be a credit intermediary. If you want to trade, if you want to do business, you cannot be afraid of the counterparty. Somebody needs to take that credit risk, and that's something that's going to be developed in the next 6 months. Simultaneously, regulators, I think, were caught, with their pants down because, a lot of these names that went down received VASP license, received a green light from and I mentioned VC funds, but even regulators. So what went wrong? And now they're coming down with the scrutiny to say, okay, show us your actual risk management model, show us your governance. So everything's, I think overall, it's going to be very positive in 1 year from now. You have less of that credit risk, but for the next 6 to 12 months, we all need to come together and answer those questions. And what we're going to see is the formulation of credit intermediaries, stronger governance, stronger transparency, and those that do not play with that are just going to start disappearing. And I think we still have a few kind of bad players, always, obviously in any industry, right? But they're not going to survive because they're just not keeping up with that transparency, with the governance and everything else. So this is probably the most important thing because, again, June was a credit issue, and I've never seen anything like it since Lehman Brothers, and that's no exaggeration.
Thank you. Khairi, you want to add something?
Yeah, just wanted to add. I think it's interesting that we have different perspectives from different companies here. And from a crypto exchange perspective, I think we at Okcoin as a marketplace where customers can access the various products, the various crypto products. We take it to ourselves and we wanted to be responsible on what is available in the market space. We went through very serious and very rigorous due diligence on every token that we list. And I think that to answer that question, in short, I think what will impact us is, I think it's only positive from here, but I think it really takes a lot for every single player, like Phil said, everyone has to play a part to make this a more sustainable financial product and asset class. I think with on a customer facing exchange, there are a lot of AML policies that we also put in place. And one of the things, not to take too much time, I just wanted to say this, that we had many policies in place. We worked with many vendors to make sure that suspicious transactions are all flagged. And one of the success stories that we had, we helped an elder retail investor from being defrauded about $1 million from their account. So I think that's something really very positive on the AML and KYC front.
Thank you. So again, progressive maturing, standardization, foundational elements being put in place for this industry. Phil said something very important, and which I want to go deeper into that. Along with investors, of course, who acted perhaps too greedy, regulators also were caught off guard, or perhaps they were trying to give some leeway to this, not suppress innovation, as we like to say, at least those on this side saying allow innovation to flourish, and you come in when you see a structural risk. Perhaps now they are sensing a structural risk. And you spoke about Lehman, and we saw at the height of the Luna collapse, it was probably similar in scale, $50–60 billion of unwinding happening over 72 hours. So recently, and since most of you are based in Singapore, let me start with that. Recently, MAS, Monetary Authority of Singapore, perhaps it was the MD Ravi Menon who mentioned this in a public speech, saying when he was asked, what is your strategy now? Because Singapore, Dubai, these places are, perhaps they have been both progressive in terms of enabling crypto innovation and welcoming many companies, but also keeping a certain standard in place. So when he was asked, or MAS was asked about their new approach in the light of these events, MAS said, we are here to support digital assets innovation, but no to crypto speculation. So they were quite categorical about it, especially for retail investors. And as we've sadly seen time and time again, right from the dot-com bubble and crash, that it's always the retail investors who are last in. They chase FOMO, and then they get caught up with FUD, and they lose their shirts in the process. Usually the institutions are less burnt. So my question to Taka and whoever else wants to then chime in and add, what do you take away from this very important pronouncement? Yes to digital assets innovation. And we've seen Singapore actually walk the talk, right? They created Partior, and then they kind of handed it over as a public-private partnership, public goods kind of a thing. So they have walked the talk, and now they are saying we'll continue to invest in, foster nurture, support these kinds of digital assets innovation, but we are not here to encourage or turn a blind eye to any kind of a speculation. So how do you, if I may say, interpret that, and what do you see as the impact on this industry over the next 18 to 24 months? And then Phil, Pam, Khairi, you guys can add your perspectives as well.
Yeah. So MAS does want to regulate the speculative side of crypto, but what they have done previously or up until now is the limit of how much on-ramping that people can do into crypto. I think the number was around $30,000 a year. And I think that's pretty much what the government can really do in terms of kind of narrowing down the speculation part. But I think what needs to come from our industry participants, is not always to kind of wait for the government to do something, but start to impose some kind of self-regulation as well. You know, some of the things that at Copper we were thinking about doing is starting some kind of advocacy group in order to introduce better practices in terms of, let's say, lending. So a lot of the contagion that happened recently is around the amount of uncollateralized lending that has been going around in this industry without proper credit risk management. So at Copper, we have this tool called ClearLoop, which allows clients to delegate virtual funds to exchanges without having to move funds, so that clients can trade on exchanges without having to use the blockchain move funds and also taking counterparty risk there. But with this tool, we're looking to add a new product enhancement where lenders can come in, lend to the clients can delegate or ring fence the collateral inside those wallets, and then be able to trade on exchanges. So this kind of creates a product where all the funds remain within one wallet, and then all the trading principal, the lending facilities, everything stays, and collateral stays within Copper. So Copper is going to kind of act like a collateral agent for both the lenders and the borrowers. So this is, you know, from our side, this is something that we're trying to introduce into the market, so that all this uncollateralized lending would be minimized to a level where, you know, the best industry practices will be more on the collateralized lending side, rather than how it's been doing for the past few years.
All right, this is a lovely topic, a lovely question. So I think the utility of crypto is interesting to me, right? In 2008, 2009, when the GFC happened, Bitcoin was invented so that you don't have to face the banks. Now, what I think the use of crypto is, in terms of utility, it provides financing for people who want financing, who can't usually get financing. We are in a very interesting time right now. You have quantitative tightening. 2 days ago, inflation prints very high. Interest rates are going up. So going forward, in terms of digital asset innovation, right now, outside of BTC2, I'm also working on a company that specializes in STOs, so securitized, token offering. And the conversation's shifting now. If you have a mega project and interest rates and financing is getting a little bit more expensive, and if credit condition, we talk about credit a lot, but the credit condition in the real world starts to tighten, well, I still want financing for this project. So the discussion we're having is, A, let's securitize these assets. Let's make it available to everybody. Cut the middleman out. Cost goes down. We secure the funding. I don't have to worry about the banks coming in and saying, hey, listen, interest rate is going to be X, Y, Z. Very interesting stuff. And this is what MAS means. Let's support the innovation. But always the question is, hey, how's the secondary market? How's the liquidity like? Yeah, sure, we can make liquidity, but you need speculation, and you need the speculative asset, the market to come in to provide that bid and offer. So I find it very interesting that MAS is saying, okay, yes to innovation, no to speculation. The real world doesn't work that way. It's yes to both, but let's focus on the utility and innovation first. And what I think is going to be very interesting, given the macroeconomic dynamics right now, is that if credit condition does indeed tighten because of quantitative tightening, and if interest rate keeps going up, and if cost for operating whatever business people have is getting too high, you say, okay, let's look at other alternatives. And I think it's a good environment for the next year or so on the STO side. Not so much speculative side, and which is weird because we're a liquidity provider, right? We should be saying, go trade crypto. But I think right now we need to focus on utility, but you can't separate speculation and liquidity, because unless you have that, STO doesn't work as well. So I should be very careful to say the MAS is wrong, but I think you can't separate the two.
Well, I think that's a very well-articulated perspective. Perhaps, and I'm no one to speak for them or even interpret what they said, perhaps they were trying to use this as a cautionary tale again for retail investors who usually get burned. Institutions, as you said, know what they're doing. When you start with innovation and when you tokenize real-world assets, as you rightly said, Phil, then perhaps speculation is a logical corollary or it's connected to it. So that is my 2 cents. But again, perhaps that's where they're cautioning the rampant speculation, and it happened all over the world. I mean, I was talking to friends in India as well, and you had millions of people, individuals trading crypto who had no clue what they were doing, etc. as well. So I think that was an important thing. You said something very important, Phil, and I'm also mindful of time, but I do want to quickly touch upon it, and whoever wants to take it. You spoke about STOs and security tokens. We've been talking about it for quite a while now in this industry, the last 3-4 years, and as it happens, speculation or rampant and perhaps crazy speculation takes center stage, and then we come back and start talking sensible stuff. Tokenization of real-world assets is perhaps much more important and offers much more liquidity and connects the real world to the crypto world when you talk about real estate, etc., especially in rising interest rate environments, peaking inflation environments, etc., versus NFTs, etc., which have very limited or zero intrinsic value. What is your view, and this is open to anyone who would like to take it, do you see this as a tipping point for securitized tokens or real-world assets to really get securitized at scale, especially when, as Phil said, and as we are all seeing, the Fed is going completely hammer and tongs on raising interest rates. Now we are hearing 100 bips being the consensus when people were not even sure about 75. When we really talk about innovation in the digital assets industry, is this the time or is this the tipping point? And will this lead to that arbitrage that we hope for, that this will be a much more efficient way of doing those transactions by cutting out banks and middlemen? Anybody wants to take a stab at this?
Yeah, sure. So even with crypto assets or even securities in general, what the crypto industry wants to do, and I think this speaks to all of like Web 2, even Web 3, is to try to get direct to the investors or direct to the consumers. But what also that implies is that the investors of those crypto assets or securities need to be well educated to understand what the risks are of investing in those asset classes. So the danger of like direct to consumers, direct to investors, is that you're taking out that middle layer who once served as an advisor to those investors that were trying to filter out the garbage from the rest. Now, in this new world where we're trying to do this, I mean, technology can do anything. They can securitize whatever, real estate, your personal income, your NFTs, or whatever it is, but the education is not really there enough to support this industry to grow without proper valuation, proper investigation into the underlying asset that they're investing in. So, what this industry, maybe it's fine to have direct to investors, but there needs to be another, institution or some kind of way that, the industry can also educate the investors so that it doesn't become just speculative, but it actually becomes an investment.
So the perpetual dilemma between decentralization and customer protection, I guess this debate is not going to go away anytime soon. We just have 3 minutes, so I do want to open the floor for audience questions. We might have time to take one. Anyone? Please introduce yourself and then ask your question, and whom you want to address it to.
Thank you. It's Tom Higgins here from Goldeye Crypto Switch. Hi. The question I've got is about the ETH merge, which is probably happening in the next 20 minutes or so. What do we think will happen to ETH? But also, what will be the effect on Bitcoin with this new super efficient protocol that doesn't use any electricity anymore?
Thank you. Just a quick note, we've been told very, very strictly by the organizer not to delve into any area which even borders on trading advice, but this is an important question. Everybody is talking about the ETH merge. So anybody wants to take a stab at it?
All I can say is just I'm monitoring ETH prices right now as we speak. I think it will positively impact how ETH is being traded, and I think ETH is moving into the right direction. And as you know, ETH is a backbone for a lot of the altcoins that we have right now. I think it's a step forward for us. I think it's a big win for the crypto industry.
So is this a key tipping point for the industry, or is it going to portend another disaster? Anyone? Without doing any crystal ball gazing, what's your view on the merge?
Great question. It's one that's hard to answer. Personally, this is going to be something where a lot of crypto enthusiasts is not going to like my answer. But right now, unfortunately, I don't think it matters that much for the price. Even after the merge, whether it's Bitcoin or ETH, we're just so much dependent on what happens in the macroeconomic sense that really anybody who says it's going to rally higher or it's going to collapse, I just feel like just looking at crypto alone has disappeared, right? It's interesting. When we look at our volume and when we look at our profile and we have a huge client base, it is so linked to economic release. I'm an FX guy, and for the first time in crypto is moving when CPI release comes out. It's almost like we need an economic calendar in place, just like we did in FX. I've been doing this since 2018. I've never seen it like it. So the volume and the interest is so fragmented, and it's moving so highly correlated with bond, equity, and FX and everything else that right now it's not a idiosyncratic story of just crypto. It's just this, whatever happens in crypto world, I would have to say it doesn't matter for probably 6 to 12 months. And again, to my point, I think we need to really focus on the STOs and the utility and everything else. And 3 months from now, this ETH merge, no, everyone's gonna, that happened in September, but that's my opinion. It's not gonna matter that much for now.
Thanks, Phil, Khairi. I'll just conclude. We are almost at the end of time, so my 2 cents on this. It's kind of ironic in a way that crypto was supposed to be the hedge against inflation, real world assets, all of that. And now, as Phil said, and my friend Ronit Ghosh, who heads digital assets at Citi, they came out with a report, I think a few months back, which said there was an 89 or 91% correlation between crypto and M1, M2 money supply and the other markets, the equity markets, etc. So perhaps it's a disappointment to the maximalists and purists, but in my view, it's a maturing of the industry. It's now become part of the mainstream that it moves. As you said, the Fed announcement moves it more than anything else. So hopefully this maturing of the industry, this cleansing of the industry and this mainstreaming of this industry will continue. And when we hopefully assemble here again next year for this, we will be seeing a much more robust, much more well-developed, but also an industry which takes credit controls, compliance, and consumer protection seriously. With that, we come to the end of our time. I just want to say a very big thank you to all the panelists for their very, very grounded and yet informed perspectives. We didn't see any of the drama that we see at many of these crypto panels, but a lot of very, very honest and grounded perspectives. So please give a round of applause to my panelists. Thank you.